Welcome back to our special show, Vodafone's Big Idea. So what happens to the stake that both Idea and Vodafone hold in Indus Towers? And it's become clear that Idea's stake in Indus is part of the deal, but not Vodafone's stake. So Vodafone Group CEO says that the effort is going to be to maximize the asset value and will work to find the best allocation of money.
Indus, we have an interest now completely aligned to maximize the value of the 11% that Idea owns, but also the 42% that Vodafone owns. And in this, we will work together with a third partner in Indus to find the possible best allocation of that money.
So Idea stake really makes for a kingmaker in the overall Indus stake because now both combined have a majority in Indus. So what is the plan there?
That's not the way to look at it, because Indus has agreement between shareholders to allow everybody to have a fair voice at the table, and never, any of the three has been dominating the other two. This is a healthy mechanism, and we are now more aligned on this side, but we have never been disaligned with Airtel. So I would see this as a joint effort to maximize the value of an extraordinary asset that this country has.
Naveen, comment on this. You know, the press release says run rate cost and capex synergy is expected to reach $2.1 billion on an annual basis. This is after a 4-year period, once the entire amalgamation is okay. Do these numbers sound sort of realistic to you? And how much of this is already baked into the stock price?
So, more or less, the numbers look quite realistic to me. In fact, I would say that they could be a little more conservative also, because considering when two such large entities combine operations, there could be other benefits which might start accruing. These would be very, very base case numbers that the companies would have worked upon. So I would say that more or less once the synergistic benefits start appearing, then probably I would say that there could be cases for further re-rating. As of now, from the perspective of the amount of synergy benefits which are captured into the price, I don't see that to be much at this point in time. So because I think the market is seeing that it will take some more time, which is what the release says, that it will be in the 4th year the benefits will accrue so much, because of which I think the market has not fully factored in. But as and when the news flow gathers on the merger happening and the operations are getting merged and things like that, we'll start seeing the market slowly factoring in these benefits.
So, Ms. Kulkarni, help me understand, is there an overestimation of the synergies also, especially with the kind of intense competition we see in the sector, where EBITDA is also eroding? And in this particular case, EBITDA will come down slightly because they will have to shed some spectrum as well.
So the synergies, and see, we are referring to two different aspects here. One is the revenue, which is essentially a case of pricing and competitive intensity, and the second aspects are cost. So costs and actually pricing are completely de-linked in the telecom market today. So costs more or less tend to be absolute. So like, let's say that network costs or the administrative costs, right? So these costs are more or less fixed costs in nature. So that is where there are a lot of synergies. For example, almost 20% of the network, there is an overlap, so they can reduce that. And then there is a lot of, I would say, synergies with regards to spectrum, right? The amount of voice spectrum that the combined entities would be needing would be half of the total amount of combined pooling in of spectrum, right? So that will free up a lot of spectrum for data, right? So which will essentially mean lesser future capex, right? So many aspects. So linking costs with the EBITDA margin and with the EBITDA number, right, at synergies at this point in time will not be very prudent, because pricing and revenue growth will evolve with time as Jio starts charging and the way things evolve in the system. Right. So from that perspective, I feel the synergies which have been estimated in an absolute sense, which the way that the company has given out numbers, seem to be pretty prudent.
Right. Mr. Mathews, come in on this. How realistic are these targets? Do you still see debt position being a problem area going forward? And will it spur more consolidation in the sector?
So I think one of the things that we need to look at which has been the fundamental issue which has driven a lot of the consolidation in the industry, is the significant amount of resources that have been taken out of the industry by the government by way of taxes and levies. Today, about 30 to 40% of every rupee that we earn goes back to the government in some form or fashion. So I think if we are looking at margins and profitability, I think this is one of the fundamental issues that the government, from a policy and a regulatory perspective, will have to address and take a look at. Again, please understand that we are the worst of both places. We started off with revenue share, and then when we went to auctions, we got hit with upfront payments, which drove our debt positions and interest, and then we continued with the revenue share. And the combination of the two has really been one of the contributing factors in terms of the sharp deterioration of what we are seeing in the industry.
Simone, quick last point on the way the deal has been structured and really what sort of lessons can be learned for future deals as well, because there are quite a few points which are up in the air. There is that 9.5% stake which Idea promoters may buy if they wish to buy at a price of 130. There's the equalization mechanism that even if they don't buy this stake, then Vodafone will have to start bringing down its own stake, and therefore the shareholding is restricted. How do you sum up sort of this kind of an equalization mechanism that this deal sets in? Do you see any precedent, and do you see sort of other deals going this way as well?
Well, I think this deal is a little unique in the sense that it needs or wants to achieve equal control between two promoters, and they've arrived at a commercial way to do this. Now, it does have an impact in terms of, especially pricing, in terms of, having a clear-cut sort of option to buy, and then cast an obligation on Vodafone to then stagger or sell its shares in the market. So it could have a price impact thereafter. Again, it looks, there are a host of sort of approvals that are going to be accompanying this entire merger process. So it's not that simple. You have, the SEBI approvals, you have the CCI approvals, many regulators, plus the NCLT, of course, and the DOT. So many regulators will have to look at this specifically to see, what the impact would be on the market and other shareholders. In addition to this, I think, the specific approval of the public shareholders will also be required, given SEBI's new circular, in terms of the majority of the minority will also have to vote, on this matter. So a lot of sort of things are up in the air, yes. Not just structures, but also in terms of regulatory approvals and shareholder approvals.
Oh yes, there's a long way ahead for this particular merger, which is very complex in nature to really fructify. Thanks so much, ladies and gentlemen, for joining us with that analysis on this big deal that we are tracking today, the mega merger of Vodafone India and Idea Cellular. You heard it first right here on CNBC TV 18, and that was the analysis coming in. But remember that telecom sector is going to be abuzz with a lot of deal activity. So from Surbhi and myself, thanks so much for tuning in.